I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a risk-alyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back, and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, and I'm the host of Financially Speaking with Jeff Bush. Topic today is something that people overlook at times, and it's not all that exciting, but it is one of the crucial building blocks in putting together a sturdy financial plan, and that's insurance. And before we get into that, Jeff?
Yeah. Well, hello, Steve. Welcome to the show. It's great to be here in our office in Pottstown. And, of course, we've been doing the show here in Pottstown for a couple of years now, and we like doing this here.
Yep.
It gives folks a chance to see what we're all about here. We're on the corner of High and Hanover Street, high atop the Security Trust building. And, of course, we're inside a nice, cool building here on this hot summer day as we record this in the middle of July. So we want to talk about insurance today. So insurance is such an integral part of a financial plan. It's really, really in its basic form, it's really the basis of a financial plan, because it's so important to cover those important needs, which we're going to dig into today.
And I feel a lot of people really don't understand insurance, and a lot of it is an education with our clients.
It is. I think it's often misunderstood and misconceived, and it's really our job as financial advisors to carry that message forward to our clients. So now we're doing it today as we speak to the masses on insurance.
And Jeff, before we get into the insurance types, why don't we talk a little bit about some of the things we've had going on in the news and how we reach out to people and help educate them.
Yeah, so in the last year or so, actually the last several years, we've really made an effort to a public relations effort, if you will, to get out there in the news, if you will. So we've been published, we've been on the radio, we've been doing this show on TV. We've really had sort of a broad scope of sort of an outreach of education. I mean, we've always, our mission has always been to inform, hence the name Informed Family. But it's been a good the pandemic sort of forced us into doing a lot of this public relations type activity. Yeah.
Yep. And you were on everything from radio stations to
USA
Today.
I was on the radio station. I was on KYW. I was quoted in the USA Today. I wrote an article for U.S. News and World Report, and we were busy last year. If nothing else, we were busy in the media.
Yep. Well, good. So let's get into a little bit. So the first one, let's talk about life insurance.
Yeah. Okay, well, let's talk about it. So life insurance, and of course, my roots were in life insurance back when I got into this business about 26 or 27 years ago, a long time ago, or so it seems. Um, Life insurance is all I did for the first several years of my career. So uh, I'm excited to talk about it. What do we have?
And term, which is the simplest, and it's a little bit like when people lease an apartment. And let's talk about term.
Yeah,
a
so
little bit.
term insurance, as the name implies, it insures you for a term. And this is probably the most popular kind of life insurance, and it's also can be the cheapest kind of insurance. And if you're insured with your employer, most likely this is what you have is term insurance. So if you go out into the marketplace and buy term insurance, you can buy you can buy 10-year level term, for example. So you get insured for a period of 10 years at a set price, and then after the 10 years, the insurance is gone. So you're insuring yourself for a very specific term. So that type of insurance is popular, particularly with young people, because they may be insuring a big asset such as their house. Maybe you buy a home, you have a great big mortgage, or if you have a young family, and you're buying insurance to protect the loss of an income.
And when someone has a term like a 10 or a 20 year, are you able to have the conversation with them and take them into 20 years and say, what's your insurance need going to be at that point? How do you coach them around that?
Yeah. Well, I'm a big proponent of having, if I'm talking to a young couple, I'm a big proponent of having both term insurance and some type of permanent insurance, which I'm sure we're going to get into.
Yep.
But the term insurance is cheapest, and it's going to insure you. Let's say, the example you gave, 20 years. So 20 years of time, right? 20 years, my experience has been that 20 years goes by pretty quickly. And in most cases, what we've seen is after the 20 years is over, there's still a need for insurance, for life insurance. So let's say you're insuring somebody who's 30 years old and they buy 20-year term. 30 years, get a 20-year policy for a 30-year-old gets you to age 50. Well, when you're 50, you still have financial obligations. You're still working. You still possibly have a mortgage. You're still educating your children, et cetera, et cetera. There's still a need for the insurance. So if you go to buy another 20-year term policy when you're 50, guess what? It's going to be a lot more expensive, because you're now insuring yourself for the period of time between 50 and 70, which is a lot more expensive than insuring yourself for the period of time between 30 and 50. So life insurance is priced based on mortality charges, mortality expenses. So it makes sense that there's a bigger risk to the insurance company when you're 50 than when you're 30. It's just,
Yep.
more people are dying. Between 50 and 70, there's health issues that are creeping in there that make the insurance more expensive. When they price the insurance, you're really put into a pool of other people buying the insurance, and that's how they come up with the price. But typically, if you're buying insurance privately, like on the open market, there's going to be health underwriting. There's going to be underwriting. So they're going to look at things like your height, your weight, are you a smoker or a non-smoker? What other health issues do you have? Are you taking medication? Are there other conditions that would increase the risk to the insurance company? So that's the other caveat, Steve, is if you're buying insurance at age 30, that's probably the most insurable you're going to be. When you're 50, maybe there's health issues that creep in. Maybe you can't even get it when you're 50. And that's why I'm such a big proponent of having some type of permanent insurance.
Now, we talked a little bit about the term insurance. Let's move into a couple types of permanent insurance.
Okay. Well, there's in its most basic form, you have whole life insurance. So there's whole life, and then there's universal life, and then within universal life there's guaranteed universal life, there's variable universal life, there's indexed universal life. There's a lot of types of universal life insurance, and that market has just exploded in the last 25 years since I've been in the business. But with whole life, typically you're buying a policy that's paying a dividend. It's based on the insurance company takes your money, they invest it in a portfolio of basically financial instruments, bonds, mortgages, things that are generating interest and dividends, and then in turn they pay a dividend to you as the policyholder, and that's an expensive way to go. It's expensive insurance, but again, it's permanent, and it's something that you have. It's a nice thing to have in your portfolio, both your life insurance portfolio and also as part of your overall investment portfolio. Because as you age, as you get older, and you're starting to build wealth, and you're starting to build assets, it's nice to have some type of permanent insurance in there, because it down the road it's going to pay. It's going to be part of your estate plan. So that's whole life, and then you get into the universal products, where their interest and dividends stay internally within the policy. So if you have let's say you have an indexed universal life policy, the underlying index, whatever crediting that's doing, it's internal to the policy. And of course, there's charges too. There's mortality charges. There's expenses. So you're building cash value in a universal life policy, but while you're building cash value, you're also there's expenses that reduce the value of the policy, and then there's interest that increases the value of the policy.
And we have the index. What about variable? How's that set up? What's that look like?
Well, variable universal is so now you're talking about sub-accounts. Yep. So now you're getting into market risk, right? Whether it's stock market risk or bond risk. There's sub-accounts that really it looks a lot like a mutual fund, like a retail mutual fund, but it's residing inside of a life insurance policy, variable universal life. They call them sub-accounts, but you can get so that's a riskier proposition, right? Because now you can lose money because it's market driven. So let's just use the example of the S&P 500, so a broad index. So you might have a sub-account that's tied to a broad index. Well, if that broad index happens to, it's funny that you asked that question, Steve, because when I got into this business back in the mid-90s, that was just becoming a popular and the company I was working for was really pushing variable universal life. And of course, if you study this, the stock market, the market was really taking off in the mid 90s. So, we were seeing all these crazy high returns, which really was sort of bad when you think about it, because people were getting used to these high returns outside of a life insurance policy. And of course, the bubble soon burst, right? Because then we had a significant market correction in the early 2000s, and that was really an eye-opener for those who owned variable universal life, because now all of a sudden you were paying into a life insurance policy and all of a sudden you're losing money. So you have to really be careful with variable universal life, because you are susceptible to not only market gains but also market declines. And I think that's why the indexed universal life became so popular, because with indexed universal life, you don't have that risk of market declines. So the market, even if the market goes down with an indexed UL, you're not going to lose principal. So so that's become a popular way to go.
And when we look at why people buy insurance, when someone's younger, it takes care of some things, and then maybe when they're older, it takes care of different things. So let's maybe compare the two. And
yeah, well,
and
so again, that gets back to my statement of you needing a portfolio of permanent insurance and also term insurance, because when you're young, let's go back to the example of the 30-year-old. So if you're 30, let's say that maybe you just bought your first house, you just got married, and maybe you have 2 children. Okay, so you got a lot of obligations. So the insurance need right now is if you die, there's a significant loss of income, right? So you've got a mortgage to pay, right? You've got 2 children to raise and educate, right? So that's really so there's a big need right there, and a need that a lot of times people don't recognize it, or either they recognize it or they choose not to insure it. And it's hard, because when you buy life insurance, you're forced to face your own mortality, because there's a chance that you're going to die, right? Most people don't want to face that reality of that there's a chance that you might die, and as financial professionals, that's our job, is to say, look, you got to cover that risk. It's all about risk management. It's no different, Steve, than insuring your car, insuring your house, buying health insurance. It's just another risk that you're covering. You're buying those things to cover risk. Like that brand new car that you bought that's sitting out in a parking lot now. Do you have insurance on that car?
certainly do,
Okay. Why do you have insurance on that car?
in case it gets hit.
Because if something happens, right, there's risk there. Now, of course, the way the rules are now, you have to have insurance, right? You have to have insurance on your car, but that you have an asset that you're trying to protect, right? So you're protecting the physical car. You're protecting if there's an injury, if you're in an accident. There's risk there that you're protecting with insurance. Life insurance is really the same thing. You're protecting the risk of, if you die, what happens? What happens to the people that you leave behind if you die? That's the risk that you're covering with life insurance. I should mention too, since we're having this conversation, if anybody wants to have a life insurance consultation, a complimentary life insurance consultation, please reach out to us. Contact our office. Maybe you even want a second opinion on the life insurance that you already have. it never hurts to review your life insurance. But give our office a call. We'll put our numbers up on the screen, our phone number and our email address.
Now, let's take that example. The 30-year-old gets a little older. They save money. They pay the mortgage off. Kids are through college. They don't have the liability need of it, but they've built some wealth. What does that look like for estate planning?
Yeah, so now that's a totally different conversation. So let's say now you're talking to somebody that's maybe in their 60s or 70s, and they've built a considerable nest egg. Now you're looking at ways to protect and enhance one's estate. So what we're finding now with a lot of estates is that an overwhelming majority of the assets are sitting in qualified retirement plans. And these qualified retirement plans are, for the most part, taxable, right? So an IRA or a 401k has a huge tax liability. All that money needs to be taxed. And if you haven't paid the tax on it while you're alive, it's going to pass to your heirs, and your heirs are going to have to pay tax on it. So oftentimes the life insurance is used to enhance that estate and help pay those taxes, because a life insurance benefit, if it's structured the right way, it's passed to the heirs on a tax-free basis. Okay, so if you're getting an IRA that's taxed, you're getting life insurance that's tax-free, and it can help. It can help pay the taxes, and it can also enable you to have a strategy now with the IRA, whether you can stretch those payments out over 10 years, or whatever the IRS is allowing you to do. And here's the other thing: there's other taxes that are due upon death, whether it's estate tax or inheritance tax, or maybe you have a house that's not liquid, right? The house needs to be sold. We've seen cases where the house needs to be sold to pay the taxes. Well, the house, there may not be a market to sell the house. I know right now, as we speak, the real estate market is pretty vibrant, but that might not always be the case. And we've seen cases where, maybe a house isn't ready to sell in time. Here in Pennsylvania, the inheritance tax has to be paid 9 months after the date of death. Well, in a lot of cases, you can't sell your house in 9 months. So if you have life insurance, it just makes it easier, because it just creates that liquidity and makes those funds available right away to pay taxes.
And before we move on to different insurance types, let's just touch real quick on how business owners may be using life insurance. Partners.
Well, for business owners, it really comes down to what we commonly refer to as buy-sell insurance, right? So if two business owners, you're in business together, one business owner dies, they're bringing a lot of expertise, a lot of strength and expertise to the business. Well, if they're no longer there, you're losing that. So the surviving partner would buy insurance on the other partners, so that they would have some liquidity to continue to run that business after the business owner dies. So in its most common form, that's business continuation or buy-sell insurance, something that all business owners should consider.
Well, good. Let's move on to long-term care insurance. And I know in my 25, 26 years in the industry, this had seen huge changes in it. So,
yeah. So long-term care insurance is really it's a market, and it's an industry that has really evolved over the years. When 25 years ago, people were buying what we now call traditional long-term care insurance. So you specifically insured the risk of you needing coverage if you went into a long-term care facility, or maybe you needed home care. You needed care at home if you got sick, right? What has happened, Steve, over the years is the cost for this type of insurance has just exploded. And people that have bought this insurance have seen rate increases that are significant. We've seen rate increase, it's not uncommon to see rate increases of like 40% on these policies. And the people that are buying these policies are people that are, are now retired and maybe on a fixed income, and they can't afford these costs. So there's such an unknown to, this traditional long-term care insurance. So what has happened in the industry, and what we've done in our own practice, is we've used the life insurance to cover the long-term care risk. And the way we do that is with a long-term care access rider. So you buy the life insurance, it's got a long-term care access rider on it, so that if you need care, whether it's care in your home, whether it's care in a facility, it could be some type of adult daycare, you're now able to access the policy. The life insurance policy is, maybe it's paying 2% per month. So it's 2% of it. So let's say you have a policy for $500,000. 2% would be $10,000 a month. So that $10,000 you could pull out of the life insurance policy and use for long-term care. The reason why that's so popular is there's really two main reasons. One is that the costs are fixed. You don't have to worry about rate increases because the costs are going to be whatever it is for the life insurance. And if you have yourself some type of a guaranteed cost policy, then it's likely that you're not going to pay more for that policy. That coupled with the fact that if you never need care, if you never need long-term care, then it simply defaults to a life insurance policy and pays a tax-free death benefit to your heirs. So it's sort of it's going to pay a benefit either way. And one of the main objections that we would get to long-term care was that, well, what happens if I never need what happens if I never need care, right? Then I just wasted all that money. Which is funny because people don't say that about car insurance, right? Like you don't say, if your car doesn't get in an accident, you don't say, well, geez, I bought all that insurance and I never got in an accident.
Or homeowners.
Or homeowners insurance.
My house
never burned down. Yeah.
Anyway,
so I never needed it.
Why don't we switch here and kind of summarize? I know we're going to be back out educating people with seminars.
Yeah. Yeah, so we're back at it. In a couple of months, we'll be taking our show on the road again. I know it's been a while since we've done that, but we're going to be doing live workshops again. So we'll put those dates up on the screen, and we're coming to an end of our show here today. So boy, it seems like it went fast talking about the insurance. We may have to do another show.
Sure.
To talk about the insurance, and I know we'll probably get a lot of questions coming in from our viewers. So we'll try to answer all those questions and address all the needs that we have for insurance. And with that, we're going to sign off here today. This is Financially Speaking.